Hello everyone. We're coming off another day of choppy trading in equities, so I thought I would say a few words on the latest developments, our outlook, and the investment impact. Let's start with what has happened in recent weeks. Well, equity markets have remained volatile and recession fears have grown, largely due to the latest policy developments around tariffs. Most recently, stocks fell sharply on Monday after President Trump suggested the country could face a period of transition and temporary economic disturbance as he pursues his policy agenda. The president's recent comments have investors worried that he's less focused on stock market performance than he was in his first term. So how concerning do we find these recent developments? Clearly, we have entered a period of extreme policy uncertainty, and we have to acknowledge that risks have increased. In fact, we have recently raised the combined probability of either a cyclical or stagflationary economic downturn within the next 6 to 12 months to 30%. Particularly concerning are the tariffs on Canada and Mexico. But still, our base case, which we assign a 50% probability, remains that US economic growth will moderate from last year, but remain positive. We do expect President Trump to maintain an aggressive stance on trade, but believe he will want to stop short of causing a recession. It's also important to remember that the US economy entered this phase of uncertainty in a position of strength, with unemployment low, still solid job growth, and an overall healthy consumer. While softer data like business and consumer sentiment has pulled back, real activity data has not yet materially changed. Finally, within markets, we also believe the large moves in certain sectors, like technology, have been amplified by extended positioning heading into the year, which has now largely unwound. So the natural next questions are, what does this mean for investments and what should you do? Our core message in recent months has been to stay invested, but also to hedge downside risks. The latter part of that advice has only become more important, with volatility likely to remain elevated in the near term. That being said, we believe the medium-term outlook for stocks is attractive and risk-reward has improved. The US remains our preferred equity market. While the S&P has lagged the rest of the world recently, we believe positive catalysts are already accounted for in a year-to-date outperformance, like Germany and Chinese technology stocks, while US valuations are now more properly pricing in downside risks. And ultimately, we believe a recession will be avoided, earnings growth will be strong, and artificial intelligence spending will continue. Policy uncertainty should also slowly decline as the year progresses. In the months ahead, we should get greater clarity on tariffs, a potential government shutdown, reconciliation packages, and more. Outside of equities, fixed income should continue to play an important role in diversifying portfolios as well. We've seen this in recent weeks with bonds rallying as stocks sold off. Here, we continue to favor high-quality segments where you can still earn good carry with less risk, like investment-grade corporates, mortgage-backed securities, 5-year US Treasuries. We did trim some interest rate exposure as the market has become pretty dovish, now pricing in almost 80 basis points of Fed cuts this year. But overall, we see the direction of travel as lower, with the 10-year yield heading towards 4% by December. We also continue to go like gold to further hedge against geopolitical risks. Stay tuned for more guidance from our CIO team. I will also be joined by Henry McVeigh, Head of Global Macro and CIO of KKR's balance sheet, for a special client live stream this Thursday at 4 p.m. Eastern. Please ask your UBS financial advisor for the details.